if you could sell a rental property and keep most of your profits instead of handing them over to the IRS? There's a simple way to do that. It's called a lazy 1031 exchange. Most real estate investors know about the regular 1031 exchange, but few realize how stressful it can be. You have to follow strict deadlines, use a middleman called a qualified intermediary, and if you touch your money, even for a second, you lose the whole tax benefit. That's a lot of rules, and it's a lot of pressure. The lazy 1031 exchange skips all of that. It's not an official IRS program, but it can help you reach a very similar result with less stress and more flexibility. Here's how it works. You sell your property. Take the money yourself. You pay or plan to pay the taxes on that profit. Then you reinvest that money into another real estate deal. So far it's exactly like a regular 1031 exchange, except you're touching the money, right? You can buy another property yourself, or you can invest into like a large apartment complex with professionals that manage the whole project. Either way, when you buy a new property, you get a tax deduction called depreciation. It's how the IRS lets you write off the part of the building's value that they say wears out over time. Bigger apartment complexes usually do something called a cost segregation study. That means they separate parts of the building that wear out even faster, things like flooring, lighting, or appliances, and write those off sooner. That creates a bigger paper loss, which that's just numbers on paper, right? It's not a real cash loss. Those losses can reduce or even erase the taxes you owe from selling your rental. You can think of it as swapping one property for another, but without the strict rules or deadlines of that 1031 exchange. And if you reinvest into a syndication, the tax savings can sometimes be even bigger. Bigger properties mean bigger write-offs, and syndicators can even choose how to divide those benefits. For example, investors into that syndication who are using self-directed IRAs can't utilize depreciation since their accounts are already tax sheltered. So the sponsor of that deal can give more of those deductions to investors who can actually use them. It's a win-win for everybody. The key is to reinvest in the same tax year that you sell your old property, so the deductions line up with your gains. And if you can't use all of the deductions in that for 1 year, that extra depreciation, it simply carries forward to future years until it's used up, so you never lose it. This strategy works best for people who want flexibility. No intermediaries, no 45-day deadlines, no rush into a deal just to meet the rule. It's not what makes the most that matters, right? It's ultimately what you keep. So you don't want to rush into a bad deal just to get the tax savings. If you can do it another way, that makes more sense. If you would like to learn more about how this works or how we structure our apartment investments to maximize these tax benefits, visit BlueVikingsCapital.com to set up a free call with me, and I'll be happy to walk you through it.